Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about job numbers and what that could do to mortgage rates in 2026. First, I want to say thank you to our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here on Fed Day. Us nerds are always very excited on a day like this, but this technically would be Jerome Powell's last Fed Day before they announce, if they do announce Kevin Hassett early next year before the Fed meets late January.
Everybody is on pins and needles, of course, even though, widely expected, what is it, over 90%? There's going to be a rate cut. We know what that is. It's more what he's going to say, correct?
So my thing is labor over inflation, of course, and that has worked out this year, but everyone is still under the assumption that the labor market is going to break eventually and that the Fed is going to be behind the curve if that's the case. So today we're going to talk about why, what if labor gets better? What does that mean? I mean, in theory, rates would have to go higher in 2026, but we're not going to have Powell anymore and they want to cut rates. So there's all these things, but Powell usually gets very hawkish right about now, just like he did last time, just like he did in September of 2023 when he went mega hawkish and the 10-year yield went up to 5%, and even the Fed was like, "What's going on here?" I'm like, "Forward guidance, homie. What did you think was going to happen?" You remember that after that thing,
Oh, yeah.
and the 10-year, and they were like, "What's going on here?" And I'm like, in any case, I do expect him to be hawkish. I do think they're still worried. Mortgage rates just getting near 6% can breathe life into housing. But we're only here because the labor market got softer. What if that didn't happen? And the spreads didn't get better. We're over 7% easily right now as we speak. And the housing data would look much different today.
Okay. So before we dive into what that would look like, I want to know from your perspective, what's the likelihood that labor gets better versus labor gets worse? I mean, it's been weakening. It hasn't broken yet. What are your odds?
So I remember 2018 and 19, and the labor market was getting softer because of the trade war. Companies didn't know what to do, what was going to happen, what the rules were. It was very chaotic, kind of like now, very chaotic. But when there was clarity toward the end of 2019, and not a lot of people probably remember this, but I do, because the data was getting better. And because the data got better, we had these really big positive job sprints, January and February of 2020, that nobody saw coming because they assumed the labor market was breaking. See, everybody went into the recession camp in 2019 as well, but the recession triggers didn't go off. And then all of a sudden, the first few months of 2020 were really good, and then COVID happened. So everybody forgot about that period except me. So now we're working from really, really low levels of jobs data. The job openings data came out today. The headline job openings data print, bond yields went up 3-4 basis points right off of that. But when you look at the internals of the data, hirings are down, quit percentage is down. Quit percentage falling means that less people are quitting their work for better paying jobs, and the layoffs picked up just a little bit. The ADP weekly data came out today. It was positive 4,700. So we're working from such a low bar with jobs data that it doesn't take much to make it look positive anymore, right? And lower rates already has done one thing. If it sticks, if the BLS jobs data does not get any more negative revisions on this data line, lower rates took a 4 or 5 month negative construction working data line and made it positive again. So there are things that if policy clears up, let's hypothetically, let's say there's no more trade war, right? The Supreme Court shoots down tariffs. We have all these tax cuts and refunds, and manufacturing depreciations are going to go. All these things are set up for 2020. It doesn't take much to have a positive year compared to having the last 5 months be 39,000 jobs.
Yes, but from your perspective, okay, a positive year, but like, do you think that we are going into a stronger category that would warrant higher rates?
Yes.
Okay.
Yes. I think the backdrop is there. If certain things clear up, boy, it is not hard to get 50, 60,000 jobs per month, or you have a few prints. So because I went through the first trade war, and because the backdrop is different, I understand what Trump's trying to do. Trump declared holy war on the Federal Reserve because he remembers what happened in 2018-19. The Fed all of a sudden started cutting rates. Mortgage rates went lower. Housing demand picked up toward 2019. Then things got better. And then, all of a sudden permits broke to cycle highs. So they kind of remember that. It really depends on how much how much does the economic variables clear up going into 2026, or are we still just going to be dealing with tariffs and trade wars and not realizing what the rules are, and then rates stay elevated and it doesn't get any help? But rate cuts do help the economy to a degree, especially as the interest cost goes down. Some deals start to make sense. So because we have such a low bar, I don't want to do what I see a lot of people doing. They're going straight into the recession camp. And they've kind of always been in the recession camp, but the bar is very low. I really want to see what Powell thinks, because when labor breaks, it breaks, man. That's just jobless claims heading up higher. It's over, man. There's nothing, you can't hide behind that. But we do have some things that are going to happen in 2026 if we get a little bit more clarity on the tariffs and everything. And if the tariffs went away and the growth rate of inflation on goods fell, right, and then we get even lower rates, you can get maybe the labor data start picking up. I know the small business labor index picked up today about hiring going out in the next 6 months. So there are things that, as analysts, we're supposed to take all the different variables out here. And I think sometimes when everyone wants to go into well, rates have to go lower because we're going into recession, and not possibly think of, well, how does that stop? I'm just trying to give a different side to it, because it's really hard to get mortgage rates under 5.75% with neutral policy. Neutral policy is taking the Fed funds rate to 3.5, or 3.25%, wherever you think neutral policy is. So we're kind of down here. So the question is, next year, if the labor data starts to get better, what does Fed Chairman Hassett say? We need to cut rates even more, or so it's going to be a very meticulously tricky year with economic data, because we've never had a sitting president put his own people into the Federal Reserve out there. So it is going to be a once in a lifetime event to see, in a very unique period of time in the economy, how that operates with mortgage rates. Because all we're talking about is where mortgage rates are going to go out here, and the labor data has pushed it lower for now. But there's limits to how much lower we can go unless the job market breaks.
So, say we get a Hassett. It sure looks like he's the front runner, right? And he's in after Powell leaves. What can he do? Like, Trump has talked about dropping rates to levels that just they're not realistic. What do you think is realistic if they get a Hassett in there, if they get a couple more Fed governors in there? What is realistic as far as cutting that they can do?
You get neutral policy, which is basically 3.25 rates at
Okay.
that point. So you have a few more rate cuts into the system out there. Again, so much of this is already priced into mortgage rates. This is why I don't go below 5.75%, because again, the market is already looking out for neutral policy. Now, when the economic data gets worse, like last year, 2024, my God, 2024, we didn't even have a rate cut into the system, and the 10-year yield broke the Hodor line. I'm like, whoa, everyone's going into the recession camp early. So
Right.
there's just realistic realities that we have to deal with rates. And we're sitting here, we're almost at 6.40% on mortgage rates with these rate cuts into the system, with spreads getting better, right? Only because the labor data got worse. So the question going out next year is, how do we track the mortgage rate 10-year yield environment with knowing that, we're going to have a new Fed president. We're going to have probably new Fed governors if Trump could fire people. But that can bring the short-term rates down. That might not mean mortgage rates get down toward 5.25 or 5.5 that like some people are talking about, but just maybe hovering around the high sixes and or low sixes and high fives. That might be a realistic, no matter who the Fed chairman is out there. Now, again, if labor breaks, all bets are off, right? That under 5.75 is in play. Spreads get back to normal for the next year. We're already there at 5.75, but it's going to be such a meticulous year. And since it's Fed day today, that it's going to really, I just truly believe Powell does his hawkish thing right about now. And it's going to be his last like Fed press event before they name the news. So I want to see how the bond market reacts, because it's not shocking that mortgage rates are in a range and the 10-year yield is in a range. It's really hard to break above 418, really hard to break below 4%. We're here because the labor data is softer and Fed policy is easier now than what it was, let's say, late 2023.
Is there any world in which the Fed can get to accommodative stance? I can't say that.
So there's been never any discussion on an accommodative stance. That would mean that the economy needs much lower rates to boost demand. So again, if jobless, I've always held that jobless claim line, right? Since 2022, we said jobless claims have to head toward 323,000 4-week moving average. If you want the Fed to really pivot to get from modestly restrictive, we're still modestly restrictive, to neutral policy to an accommodative stance, jobless claims have to break. And the whole point of all this discussion in the last few years was that telling people, hey, listen, they are going to stay as restrictive as possible. These are the exact words we've used for years now, until the labor market breaks. They are still today telling you we are modestly restrictive with the lowest job growth in the 21st century. So this is by choice. This is a policy choice. We are about to take away the person who advocated that policy choice away, and Kevin Hassett will be there. Now, Kevin Hassett is going to give unbelievable positive forward guidance that Powell won't do. So it just becomes interesting in this market sense, because if the economic data is getting better and the labor data gets a little bit better, where do rates go down, even with a Hassett and, Stephen Myron, and maybe, Trump gets one or two more people into the Fed? That becomes a more conflicting story. So it's just something to think about for next year, because it just seems like to me everyone is going full blown into the lower mortgage rate camp. But what if the labor data did get better? And there's enough hawks still on the Fed to kind of push back on whoever the chairman is out there. I do think that's going to change. It could get very, very testy next year with Fed governors, if they don't think they have the numbers to get the votes in. So, it's going to get interesting. It's going to be such a unique 2026, because we're dealing with stuff that we have not dealt with in recent history, and we get to see how the markets react to it.
The trade war is really interesting, how you unwind that from now. So are you saying that if the trade war goes away, if the Supreme Court says you cannot do these tariffs, unilaterally, the way you've done it, whatever, without Congress, that if they do that, then rates go up? That's what you're saying.
Well, here's the thing. That's if the trade war ends and all of a sudden the economic data gets better and the growth rate of inflation, boy, you need the Fed to hey, listen, we really want to get to neutral policy now, because the one thing that was holding us up was the trade war. Now that's gone. What if that doesn't happen? And the Fed they don't have enough votes yet to get policy down to neutral fast enough out there. And I just remember that in 2019, when the economic data was getting better and everyone just kind of ignored it. I mean, I wrote a whole article about it. Before COVID, we had rising retail sales, housing permits broke out, existing home sales broke out, new home sales broke out, manufacturing data was positive, the ISM service was all positive. Every single data line that we think about in expansion all went positive. Then COVID hit. So it's just something to think about for next year, because it gets a little bit tricky with the Fed now. Because I just, to me, it's hard for the 10-year yield to really get below 380, and it's hard for mortgage rates to get below 5.75 unless the spreads get better or we get, we ditch the modestly restrictive or neutral policy. So there is a reason why we don't go below 6, because if you look at the history, the Fed funds rate is, spreads are, you could see why it's difficult to do that. And for the last 3 years, that's been the case, right? The only time rates get better is when people are worried about the economy and it's a growth scare.
We've talked so much about mortgage spreads and how they're the hero of this year and really last year. It took so long for them to come down. What are some things you're looking for in 2026 regarding spreads? Like, here are the things that could make spreads worse again.
The history of spreads, when they work from elevated levels going all the way lower, but they haven't got back to the normal trend, you still have a leeway to go lower. Now, the one time spreads got worse this year, about 20 to 25 basis points, was Godzilla tariffs. Godzilla tariffs created major chaos. Why? Because the stock market was down 20%. And then funds had to liquidate their bond funds to raise cash. So all hell broke loose, right? But when we look at 2025, before the year started, we said, what does Trump need? He needs a lower dollar, he needs lower rates, and he needs oil prices down. And even with all that, it's still problematic for the midterms, right? This is why these trade wars are difficult around, you have 2-year political cycles, right? And then you have voters, and then in Congress, becomes how, you get Democrats back in there, the last 2 years are going to be more difficult. So many variables are up there that are not normal, that we don't really deal with, that we're just going to have to play close attention to this, because I tell you, when you are dealing with the 21st century lows in job creation, it doesn't take much to get a little bit of improvement out there. So I think this is part of the reason why Trump wants Kevin Hassett, because he can't imagine if all of a sudden the economic data gets better and he's got someone like a Waller or a Bowman that says, hey, well, the labor data is getting firm. He still wants lower rates, right? He wants rates as low as possible out there. So it's conflicting, right? There's a lot of things that just aren't what we would see in a normal cycle, that we get to test case for the first time in 2026 out there. And just like purchase application data was working from the lowest levels ever, we've had 43 straight weeks of double-digit year-over-year growth. The last 30 weeks have been double-digit year-over-year growth, but you're working from a very low bar, right? The jobs data is working from a very low bar. So I thought of that when job openings data, the headline data beat, and bond yields went up. Even though the internals were soft, bond traders are just working off of certain things right now. So it just means that we have to be a little bit more focused and disciplined going into 2026.
Agreed. And I once again feel like our Housing Economic Summit on February 10th, what great timing. We do that on purpose because we should have some answers by then on some of these things. And then we can set up, this is what 2026 is going to look like. We have an amazing day full of speakers. You especially are going to be our keynote. We have a ton of great people. So sign up for that. And Logan, thank you so much. I'll talk to you again soon.
Pleasure. Can't wait to hear what Powell thinks. I made a little AI video of him with a Santa outfit with no shirt on.
That was bad.
And just like with Rudolph and just very happy. And I said, we need to give Powell this joyful look for the Fed press event and get him in a Christmas spirit. Not Ebenezer Scrooge, not doing humbug. Say, hey, listen, it's okay if you give a little bit of positive forward guidance. You don't have to be, Scrooge for Christmas.
We will see. It's either the Grinch or Scrooge or maybe Santa. We'll see which one we get when later today when that comes out. All right. Thanks, Logan.